All right, we're back for another episode of the YVR REMO Show. We're getting near to the end of the year here, and this is our favorite time of the year for a lot of reasons, but especially when it comes to doing this show. We love to always recap and look back, and this is our annual year in review episode of 2023. So we're going to get into really everything that occurred this year, and there's been a lot. It's been one of the toughest years in the mortgage industry, at least in my career. This has been one of the toughest years to experience, and so there's a lot to touch on, and there is a lot of negativity embedded throughout this year for sure, but we've learned a lot. There's been a lot of creativity that's come from this, and there's a lot of great things to look forward to. So we'll dive right in. Today we got Tyler, Derek, and myself, Dean, here, and let's dive right in.
Yeah, I guess favorite time of year, like ending. I think it's probably almost like the favorite time of year because this year is finally ending. We're gonna put a bullet in the head of this year just because it's been. Yeah, I guess the word I've been using to describe 2023 has just been sluggish, right? Like it just any sort of momentum that you think is building, any sort of positive news you're holding on to, eventually peters out and fades away, and it's just been like a slow grind throughout the whole year. If we think back to what the year started at, almost even this time last year, rates were cheaper than they were now. But then through the spring, we saw them dip to, looking back now, like those look like great rates based on what we're seeing today, right? We started seeing a lot of numbers in the fours, mid to low fours. There was plenty of money under 5%. And if you worked in the real estate industry, either as a realtor or mortgage broker, you felt that things popped, right? Like it was busy. It looked like everything was coming back. It looked like the pain was over, and it was looking back. That was probably naive to think that, like, for the back half of 2022, things slowed, and to think that was all it was going to be at these rates was probably not. I don't know. Looking back now, it seems like that was definitely the wrong train of thought, just with what happened, right? So I would say winter 2023 was slow. There was some activity building. We did see rate hikes in December and January, but again, as I mentioned, spring, it was super busy, very active. We saw subject-free offers. We did a podcast on that, right? So people were writing at ask or over ask. The Bank of Canada came out and said, we're hitting pause. And guess what? They were wrong and changed direction. That's sort of been their playbook in the last couple years. And then we had 2 rate hikes in June and January. So all that momentum through the spring that really looked like things were kind of going to get back to a busy market. June, July came, those rate hikes came 0.25% each. And it just, again, if you worked in the real estate market, it just sucked the life right out of the market. I think a lot of us were telling ourselves in around August, it's like, it's always slow this time of year. People are taking their holidays. Kids are going back to school soon. So the market, and it is true, August can usually be slow, but we were all thinking, okay, September, things might turn around. And September came and it was dead quiet, right? In through October, dead quiet. Interest rates were kind of peaking until sort of around the end of October into November. Like now we're starting to see some light at the end of the tunnel in terms of interest rates. Obviously still a long way to go, but yeah, that's my description of 2023, sluggish.
Put a bullet in it.
Yeah, exactly.
Yeah, you bring up a good point about the spring market, right? And to be honest, like we didn't see that much of a change in regards to interest rates. Like they came down, 0.5%, maybe 0.75, which is it's significant, but rates are still high at that point. And we had 2 Bank of Canada pauses, but the market completely took off, which just goes to show, like clearly there's still a massive demand for real estate. There's a lot of people that want to get into the housing market locally here because everyone can see, the massive benefit that it can have for you financially. And I think that's going to happen again, most likely next year. I won't put any predictions as to what month or when, but they are calling for some Bank of Canada rate decreases next year. And in my opinion, like there is a massive demand, and I think everyone's looking for the bottom of the market. And property values, believe it or not, are actually up nominal, but they're up over last year, right? Which tells you something. Last year they came down. There's a pretty significant drop, especially in the detached home market. We saw some properties come down $400,000 or $500,000 over the course of 6 months, while we were dealing with drastic rate hikes. So, I can just foresee when we start to get some rate decreases that there's going to be a massive rush of buyers trying to get into the market or trying to make sense of that upsize, which they've kind of just paused on for the last year. And again, from a consumer perspective, rates are high. There's a lot of instability and unknowns in the market, and I think people just kind of throw their hands up and choose to stay where they're at and not make any, big decisions financially or in the housing market when we're dealing with, rates like this.
Yeah, and understandable. Like if you can, look back to what Tyler mentioned, like subject-free offers earlier in the year, that was kind of what occurred at that moment. Is people thought that was the turn, and there was just this big rush to get in and get what they thought was a deal. And in hindsight, you look back, and it was probably one of the worst times to buy. When you consider what the values were then to what they probably are now, and what they're going to be going forward. So there's obviously that concern to jump in too quick again, and I think that's one reason why it probably just won't bounce back like that so abruptly, and just all of a sudden we have subject-free offers. But I've definitely learned this year. I'm not making any predictions. Learned that the hard way from all sorts of reasons, whether it comes to rates, what the bond's doing, what some of these reports are doing when we're looking at the economy. It just doesn't make sense to make predictions right now because it's so up and down. And we were talking just before we started airing in regards to just the U.S. economy and how it is such a driver of what we are doing here, and makes it a lot of times it's hard to just look at one outlook or one expert's opinion and try to make a prediction. It's almost impossible, right? So why don't we just jump into the rate direction? And when I talk about rate direction, more so around like what was the common term that we were seeing clients take through the past year? That was a really interesting development that I saw from this year, is just the amount of people that were going with short-term fix. And historically in my career, it's primarily been a 5-year term. Almost always somebody would take the 5-year fixed or the 5-year variable. And for a lot of clients, variable was a big direction, a couple of years ago. And then looking at this year, the magic term was the 3-year fix. It appeared to be the 3-year fix, especially for our office.
I think if you talk to any banker or broker across the board, like that's like, even when we're competing with another bank, like I'm noticing even on renewals, or if someone comes to us that they've already been pre-approved, like the number they're bringing back, oh, they've held this rate for us, it's been a 3 years. So yeah, like if I think about buyer psychology, like why would you buy in a market where interest rates are high? It's because you want to capture values while they are depressed based on where the interest rates are now, right? So the idea would be, and I'm just like how we saw in spring, there was quite a pop, and still seems to be quite a bit of demand building there. The idea is, okay, let's grab short-term money, buy while values are down, suck it up for a year or 2 or 3, and then hopefully renew and refinance into cheaper interest rates to sort of capture the upswing of the market, right? It's changing now, and we'll get into how the year ended, but there was no variable taken for like the first 3 quarters, unless you're a very specific scenario. Maybe you were going to sell the home soon. Nobody really took a variable throughout the year. I mean, the ideal term for most people was like a 1 or 2 year fixed, but the banks, they're not stupid. That's what everyone was piling into this time last year, and they just jacked those rates up, right? And so the 3 year was like the nice middle ground between you're getting some discount and you're not locking in long term. I mean, we've talked a million times about how bad fixed rate penalties can be on longer term money. So yeah, it like the trend was definitely short term fixed, and like pretty much little to no variable taken.
When you look at pricing on a 1 or 2 year, like if I was taking a mortgage today, if it was the same rate, I would probably opt for a 1 year, hoping that in a year from now rates are on their way down and I'll jump into a variable and ride the wave. But you take a 1 year today, you're looking at 7%. You take a 3 year, you're looking at 6, right? Maybe even 5.99. So it's such a big change in payment, and obviously payments are high because rates are high. So 3 year might be a little bit long, but again, just explaining to every client that's taking that, like you're in it for 3 years, it honestly probably won't make sense to refinance when rates do come down because the penalty will be so high. So you just have to, make sure you're prepared to stay in that product for a full 3 years.
Which that's another new interesting trend that we saw this year, is the fact that the fixed rates have been lower. Like the 3 year fix, as an example, which you just said, it has been a lower product to everything else that was available. And of course, that's a big reason why people were attracted to that, is because that was the lowest of options available to them. Or the 5 year, maybe not so much on the 5 year fixed term, but looking at the 5 year fixed term, it's just, oh gosh, like I can't imagine having this rate for that long. Like a lot of people have the wherewithal to understand that it's probably not going to last 5 years. So that's probably not the best option. And historically, where the trend was was really different this year is historically we've always seen that variable rate be the lowest option on the table at that current time. When you're going to sign the mortgage documents, the variable rate term was always the lowest rate. So that was another reason which drew people into the variable was again, going back a couple of years, is it helped them qualify for more. Like that was a strategy a lot of people had, was they would take the variable rate to just simply qualify for a higher mortgage amount. And then when that started to change and we started to see the rates be lower on the fixed terms, it was just a natural direction, especially with rates being so high. Like you need everything you can to get qualified. Like it's we're qualifying at the stress test, which is 2% on top of the current rate, which is quite significant. And to have a rate that's maybe 50 basis points lower, it actually does make a pretty significant difference on qualification. And that's another reason why folks were looking at those terms. So one thing I just want to touch on that, because that trend was so prominent this year and last year with the the short terms, is it's creating a big balloon that's coming in 2025, 2026 for some significant renewals. There's going to be a lot of mortgages coming up for renewal because so many 2-3 year terms were signed this year. And in addition to that, in 2020, 2021, there was a significant number of 5-year fixed terms or 5-year variable terms written at that time, which are all going to be renewing in that 2025, 2026 window. So that's something interesting to look forward to for our industry and us in this industry. And then just for borrowers in general, I would imagine that renewal departments and banks are going to be very competitive in those years, given how many mortgages are coming up for renewal.
I mean, just on that point, banks are very strategic on this, and they actually don't like the fact that there's a ton of renewals in a short period of time, because it puts them at risk for, if there's payment shock, potential default. At the same time, they could lose a lot of mortgages at the same time, right? They could lose a lot of loans off their books. So back to pricing, like that's why they started to jack up. Like Tyler mentioned, they jacked their 1 and 2 year up to try to defer people out to longer terms, just to spread those maturity dates over a longer period of time.
Maybe last thing on rates from me, like if you just think about the actual number, we'll just compare 3 years. This time last year, we're sitting around 5.5. In the spring, they kind of bottomed around 4.5. The peak was probably in October, and we were at like 6.8. And then now we're probably just tipping below 6%. So there was a ton of volatility and variance throughout the year. And a lot of that, probably everyone's sick of hearing this word. It's just due to the inflation, right? Inflation reports. That's really what's been pricing and driving interest rates throughout the whole year. I mean, it does anyways, but it's obviously been the biggest story over the last year and a half with the real estate industry and everyone's cost of living. I guess sort of on the positive side, and why I mentioned earlier, there's some light at the end of the tunnel. Like when we started the year, I think the inflation report in January came out at like 5.9, right? And the last one we just had was 3.1. So pretty close to the Bank of Canada's target range. So that means, these high rates, why would they go that high? Because they're trying to slow things down. And it certainly feels like that's coming. Again, as Dean mentioned, we're out of the prediction business, but like why we're starting to see light at the end of the tunnel is inflation is cooling. We're seeing rates get cut by banks. I mean, we just had 2 major banks last week in our world drop rates. And a thing I've noticed too, like we've done a lot of work on renewals, getting people to get on top of their renewals well into next year. I've even noticed in my last handful of conversations is now suddenly banks are getting in touch. Like all year we saw banks leaving renewals and calling people late, sometimes updating you through your mobile app or calling you like 10 days before your maturity date because they want that rate to run up before they lock you into a renewal. And also, this might be a little too tinfoil hatty, but then you're kind of stuck, right? If you got 10 days to figure it out, you're just going to renew with your lender. Now, the last handful of conversations I've had with people, banks are getting in touch with their clients and they're 2 months out, they're 3 months out. So you think about bank psychology, it's like, okay, yeah, let's start booking these in now. It seems like the peak is in, rates are rolling over. Let's book this interest income now before rates really start to fall.
Tinfoil hatty.
So, I mean, that's
been a long year.
Yeah, it sure has. So let's just quickly touch on the Bank of Canada rate hikes and what what occurred this year there, and then we could briefly touch on the bond market because that's been a bit of a roller coaster as well, and we're currently in a I would say arguably a complete drop off from a bond perspective. So let's touch on the Bank of Canada rate hike. So in January of this year, 2023, we had our first increase of the year. It was 0.25%. And then in March and April was when we hit the pause. And that was when, so two pauses, that was when we ultimately saw that rush of the market, that, crazy activity, the subject free offers, because ultimately Canadians thought that we were now pausing for good. And because of all that crazy activity, it actually spiked inflation again. We actually, had some real concerns with inflation at that point in time. And that was when the Bank of Canada stepped in again in June to shock us with another increase. And it was a shock because of just the crazy activity that we saw from, March, late February to through to April. And then in July, the very next meeting, we had another increase, 0.25%. And again, at that point in time, those two increases back to back, people were really concerned. We saw a lot of clients in variable rate mortgages either have to sell because their home, it was just too expensive, or restructure their mortgage and lock into a fixed rate. So we saw a lot of activity in that point in time, with more so panic and concern about budgets and just, where the future was going. A lot of folks just, were concerned of where is the end. And then ultimately we started to see things turn again in a positive direction. Well, ultimately a negative direction. One thing that we've learned is, like, bad news is sort of good news this year when it comes to economy relative to rates in our industry. The bad news is we did start to see some job loss and some pretty significant change to our economy, which ultimately meant another pause. So we've been paused on interest rate hikes as of September and October. The meetings were a pause, and the last meeting of the year is December 6th, which is coming up. We're actually recording this episode before you're probably listening to it. So the hike or decision to continue the pause would have been posted after this episode has come out. But December 6th is ultimately the last meeting of the year, and we are expecting another pause. So then looking at where the policy rate started at the beginning of the year, we were at 4.25%. And we've ended the year at 5%. So we've had 0.75% of increases this year. Again, assuming that December 6th is a pause, which I would say we're not in the prediction business, but we're probably pretty good, safe to say that is going to be
I'm
a
buying
pause.
lunch if they hike. I'll say that.
Okay, great. I'll take you up on that. So that's where we're at. So that means that the bank prime rate started at 6.45% this year and ended at 7.20%. So prime rate as of today is 7.20%. So just wanted to touch on that just to kind of recap. It was a roller coaster year, to say the least, and the bond market kind of followed this whole trend as well.
Obviously, variable rate borrowers, they took a beating again. I guess if you want to be positive, it was only 0.75% of increase versus like 3.5%, I think, the year before. We've done a lot of work on this. I mentioned already. I would say renewals have been downright ugly. Just banks acting really slowly, offering crap rates. It's just, it hasn't been pretty from that end of things. But I would say, starting to look at the good news. I mean, Dean mentioned the last couple rate announcements have been paused. Bond yields have come way down, especially since October. We're starting to see banks cut rates. If you read much in financial media, if you read much in financial news, like, suddenly you're starting to see way more articles come out talking about rate cuts. I mean, again, one thing we've learned is everyone's been wrong with rate cut predictions, but for the full year, it's just been like, we're doomed. Rates are going to the moon. They're staying there forever. And now the tune is starting to change. That's a positive, right? So as we roll over and really rates start to come down, we're going to start to see more people get back in the marketplace. Obviously, we talked about the spring, and even the summer was kind of busy because everyone was racing to get their rate holds captured before they bought. So, I think buyer sentiment is probably only going to get more and more positive from here if this rate trend continues, and it could, we'll see what 2024 looks like, but it certainly seems like a lot of like the worst is behind us, hopefully, and the future looks a little bit brighter. I mean, we did have some other positive news stories. I mean, we did an episode on the financial or the first home savings account. That was a win for the marketplace, I would say. Probably one of our biggest bigger lending supporters in Scotiabank came back to the marketplace after some funding issues that they had, and they're offering competitive rates. And that's what you want as a borrower, as a realtor. You just want more competition in the mortgage space. And that just means rates come down and everyone's cost of borrowing goes down with it.
Yeah, maybe just a clarity piece on rates, because we've been talking about, rates coming down now and rates coming down in the future. So like you got to tie it back. There's the Bank of Canada, which has only gone up over the course of the last 2 years, essentially. And the predictions for Bank of Canada cutting, like that will have a direct impact on variable and people that have a line of credit or even an unsecured line of credit. So people that are sitting in variable mortgages, as much as we're talking about rates coming down right now, that's tied to the bond yields, which is tied directly to fixed interest rates. So someone that's sitting at a 6.6% variable, there's no change as of today. Like your only real option there would be converting to a fixed. If fixed rates came down significantly and you really needed some payment relief, you could look at actually converting the mortgage. But again, if things are trending down, you probably want to hold out as long as you can to see where they land. But yeah, the people in variable mortgages, like you might not be getting any relief. Well, you won't be getting any relief until Bank of Canada does make a decision. So we're all hoping and praying that that's sooner than later. And some of these predictions are talking about mid next year.
One thing we'll just touch on here as well is just Tyler mentioned some of the policy changes that took place. Why don't we touch on some of the restrictions that occurred? There was a pretty major restriction when it came to short-term rentals, Airbnb properties in BC. So that occurred, and that was actually this most recent month of November. Why don't we touch on that a little bit? I mean, it's for people that own Airbnb properties in the city of Vancouver, it's actually really no change. It's how the city of Vancouver has ultimately been operating this whole time. The rest of BC just pretty much adopted what the city of Vancouver has implemented. So that is an interesting development, because that could certainly force folks to have to, people that own homes that are a landlord that have a short-term rental in place, maybe they're considering having to turn that into a long-term rental, which I think is the goal there with the province, is to ultimately get more inventory for rental, because as much as the lack of inventory has been out there for many years now, when it comes to buying real estate, the rental market has been suffering at the same rate as well. There's just a lack of rentals. So that was an interesting development. Anything to add on that?
Well, no, I mean, that the reason they're doing that is just obviously, the housing crisis. That's like always the big headline. But if you think about like inflation and all that, like not to dive back into that, but one of the biggest drivers over the last 3 or 4 reports have been rent and mortgage interest cost, right? So how do you reduce the cost of rent? You increase more supply. And like, how you increase more supply when we don't build enough, right? They've just kind of, the government sort of just basically put their scope on Airbnb and just figured, like I was listening to a podcast the other day where they're saying this should release up to 30,000 units from short-term rental to possibly long-term rental. So why did they do it? I mean, that's the goal, to get rents down.
Yeah, well said. I mean, I don't think there's too much more to add there. We talked about some of the trends, short-term fixed mortgages in regards to rates, but one trend that we definitely saw almost get eliminated was people buying investment properties. That was a huge part of our market for the last, probably 5 years of just people buying property for the purpose of renting out or, doing an Airbnb, depending on where they're located. So we saw very little investment properties purchased, and ultimately it's because of the interest rates being so high. It's very hard to make sense of a property from a cash flow perspective. But I do see that potentially changing around, and that's probably something we'll touch on in our next episode for predictions of 2024. But anything to add on that front?
Yeah, I mean, that's a direct tie to a huge part of the reason as to why rents are increasing as well, right? You picture a landlord that is in a variable mortgage, like most of them probably are. Their rates have increased, and any opportunity that they get to jack their rents up, and it's just a marketability and lack of supply issue. And I mean, just to touch on the lack of supply, like there's a lot of developers that have chosen not to build out their projects right now because they don't want to sell pre-sales in a down market, and they don't want to take on financing at high rates, and construction costs are through the roof. So, you fast forward to when rates are actually coming down, like the supply issue is even worse than it's ever been, which not good for people trying to get into the market because it keeps values high and strong. But people that own real estate, like that's why I think we'll continue to always have a strong market here. It's literally lack of supply. I mean, you got 500,000 people immigrating to Canada every single year at minimum, right? So I don't know. I personally do see the market totally turning around when rates start to fall. Bank of Canada rates, I should say.
This was probably what we'll wrap up here, is just in regards to lenders and some of the new lenders that we've seen come into the channel or revamp product servicing. Why don't we touch on that? I'll start it off with just Scotiabank shored up their balance sheet in a significant way this year. They were historically been one of the largest, if not the largest lender in the entire channel across the country. And this year they definitely took a step back in a pretty significant way. And how they did that was just really pricing themselves right out of the market. Almost all year, they've been one of the most expensive options available from a AAA perspective. And yeah, I mean, that was a big development for us. And that forced a lot of brokers in our space to have to look at other options, and other options being HSBC, being a big, I guess, beneficiary of that decision that Scotiabank made to take a step back. And TD Bank, I would assume, probably swallowed up a lot of business as well in that regard.
Yeah, I mean, if you think about options, one thing we've really noticed on our side of the business is like bank guidelines and policies. Those are only like they just kind of always get kind of clamped down on, right? So there's not a lot of like new innovative products that come out from the banks. They're sort of hamstrung by what they can and can't do based on regulations. But where we see a lot of expansion is just in the alternative lending market and the private lending market, right? I don't know how, like, it just seemed like every one of our mortgage finance partners, these are broker access lenders, came out with a new lending arm of their business. So, and this is good news, right? This has really helped servicing people that are self-employed, newly self-employed, maybe buying, in different areas or like non-traditional areas, maybe have some credit challenges. Like, the expansion of this market really only helps that segment of the population and that segment of borrowers, which is only going to grow, right? Because people that want to buy are going to buy. And as the bucket of approvable loans shrinks at the banks, that means there's spillover, right? So, I would say, expansion of new alternative lenders has been a big positive. Private lending options has been a big positive. HSBC kind of, although I don't know if Derek, you want to talk about HSBC, but looks like they're getting bought, and ultimately, I don't think that's a good news story.
Yeah, I mean, from a competition standpoint, definitely not. You want as many lenders as you can competing against each other to keep everything fair, right? So we'll see what happens with that. I mean, there's talks of RBC just converting HSBC over completely, making it blue, changing all the branches, but I mean, time will tell, I guess.
Yeah, it's a big endeavor, and I mean, there's a lot of time that needs to. I mean, there's a lot that has to happen during that time for that to actually make a full switch. So, that's something to look forward to in 2024 and probably 2025 for that matter. But another big one that was announced this year is Bank of Montreal is coming back into the broker channel. That's a really big news story this year for a lot of reasons. That just back to ensuring that there's more competition for borrowers. Looking at what they offer from a product perspective, there are certainly some unique products that they offer that are going to be very exciting for us to be able to offer our clients. So really looking forward to that. I believe their first official launch of accepting a file from a mortgage broker is going to occur later this month, I believe, maybe early next month, and in Ontario only. And so we look forward to having them as an option in BC. Maybe we can just touch on quickly just some of the smaller credit unions getting a little bit more active in our channel. And maybe I'll pass that one to Tyler.
Yeah, I mean, again, as major bank policies continue to get clamped down, we need other sources of good financing, right? So being able to align yourself with a broker that has access to all these smaller credit unions is only going to really help you benefit from other pricing options, right? And the difference about a credit union versus a major bank is they're regulated provincially versus federally. So oftentimes they can get a little bit more creative with different products, maybe avoid the stress test, maybe treat rental income differently. So again, to my further point, we're starting to see them kind of come out and be bigger players throughout the year when the market's a little bit down. So that was a big win for us.
Yeah, the only other thing that I would add in here to wrap this up is just how common alternative and private lending has become in the last 12 to 18 months. I mean, qualification to get a mortgage from a bank is extremely difficult. Like we're talking about, if you're paying 6%, we're qualifying you at 8. Restrictions are tight with conventional A type lending. So, alternative or B lenders is kind of what they've been historically known as. These are banks, these are institutions. They've always had a bit of a black cloud. No one wants to go that route if you don't have to, but their rates have been very competitive. They've been pretty similar to the banks. There is extra cost, there is a fee, but it's a standard mortgage product. And we've seen a ton of people taking advantage of that just because it is more flexible. These are often situations where people will have no issues affording the mortgage payment. They just simply can't get the mortgage from a bank because of regulation. So that's become very, very common. And it's nice to see because, again, there's always been this black cloud around these products, and private lending has absolutely exploded. Private lending is, there's very little qualification or regulation. It kind of needs to make sense is how they look at things. There's got to be enough equity. You got to be able to justify how you're going to make the payments, but they're not putting a lot of weight on qualification. They're not stress testing, and this has gotten to the extent of a lot of private lenders that hold hundreds of millions of dollars in investments quite literally have zero money to lend out. Big part of that is people that might have taken a private mortgage that were planning to pay it out a year later. They're simply not qualifying. Like their exit strategy is not working, so they end up hanging on to that mortgage for another year or what have you. So, private lenders have had a great couple of years here. Investors, the people putting the money into these mix or private lending companies are getting great returns, and there's definitely a need for that, and especially right now.
Yeah, well said. I mean, we touched on a lot here. This has been an eventful year, to say the least, in our industry. And I think that's a great point to just wrap it up. As much as the roller coaster and negativity that occurred this year, we do feel quite optimistic about the future. And we're going to touch on that in our next episode, in our last episode of the year, our predictions for 2024. It's certainly one you're not going to want to miss. So we thank you for listening. Definitely encourage you to listen to the next one and continue to support us. Your feedback goes a long way, so please continue to reach out. Let us know what you want to hear more about, what we can touch on. 2024 is going to be a big year, and we're really excited for what's to come. We do have some pretty cool changes coming to our business and our format here, which we'll be announcing in the new year. So, yeah, we look forward to all of that, and thank you for listening.